Question 1. An individual wants life insurance that provides a death benefit if they die within a specific period, but no cash value accumulation. Which type of policy best fits this need? A. Whole life. B. Universal life. C. Term life. D. Variable life. Answer: C. Term life. Term life insurance is designed to provide coverage for a specified period, offering a death benefit if the insured dies during that term. Unlike permanent policies, term life does not build cash value and is typically less expensive in the initial years, making it suitable for temporary needs like covering a mortgage or providing income for children until they are grown. Remember that term insurance is like renting insurance. You pay for coverage for a set time, and if the term expires without a claim, the coverage ends. Question 2. Which statement accurately describes the incontestability clause in a life insurance policy? A. It prevents the insurer from denying a claim due to suicide after a specified period. B. It allows the insurer to contest a claim at any time if fraud is discovered. C. It prevents the insurer from denying a claim based on misrepresentations in the application after the policy has been in force for 2 years. D. It guarantees that the policy will not lapse due to non-payment of premiums. Answer: C. It prevents the insurer from denying a claim based on misrepresentations in the application after the policy has been in force for 2 years. The incontestability clause is a standard life insurance provision that limits the insurer's right to deny a claim based on material misrepresentations or concealment in the application, typically after the policy has been in force for 2 years. This clause provides policyholders with assurance that their policy will not be challenged after a certain period, even if an innocent mistake or omission was made during the application process. Think of it as a safety net for the insured, ensuring that after a reasonable time, the policy's validity cannot be questioned. Question 3. A policy owner cancels their whole life policy and receives a portion of the premium back. This is an example of which non-forfeiture option? A. Extended term. B. Reduced paid up. C. Cash surrender value. D. Automatic premium loan. Answer: C. Cash surrender value. The cash surrender value non-forfeiture option allows a policy owner to terminate their permanent life insurance policy and receive the accumulated cash value, less any outstanding loans or surrender charges. This option provides liquidity to the policy owner, giving them access to the savings component built up within the policy. It's important to remember that by choosing the cash surrender value, the policy's coverage ends, and the insured no longer has life insurance protection. Question 4. All of the following are primary factors in determining life insurance premiums except: A. Age of the insured. B. Gender of the insured. C. Health, medical history, of the insured. D. Marital status of the insured. Answer: D. Marital status of the insured. Life insurance premiums are primarily determined by factors directly related to the insured's mortality risk, such as their age, gender, and health, medical history. Actuarial tables and underwriting assess these factors to predict the likelihood of death. Marital status, however, does not directly influence an individual's mortality risk and is therefore not a primary factor in premium calculations. Always focus on factors that directly impact longevity when thinking about premium determination. Question 5. What is the typical free look period for life insurance policies in Texas, allowing the policy owner to return the policy for a full refund? A. 7 days. B. 10 days. C. 20 days. D. 30 days. Answer: B. 10 days. In Texas, the standard free look period for life insurance policies is typically 10 days from the date the policy is delivered to the policy owner. This provision, also known as the right to examine period, allows the policy owner to review the policy terms and conditions and, if not satisfied for any reason, return it for a full refund of premiums paid. This important consumer protection ensures buyers have time to make an informed decision without financial penalty. Question 6. A policy owner neglects to pay their life insurance premium. Which policy provision prevents the policy from immediately lapsing and allows for a period of grace? A. Reinstatement provision. B. Automatic premium loan provision. C. Incontestability clause. D. Grace period provision. Answer: D. Grace period provision. The grace period provision in a life insurance policy provides a specific period, typically 30 or 31 days after the premium due date, during which the policy remains in force even if the premium is not paid. If the insured dies during this grace period, the death benefit is paid, minus any unpaid premium. This provision acts as a safety net for policyholders, preventing immediate policy lapse due to a minor delay in premium payment. Question 7. What is the primary purpose of the Medical Information Bureau, MIB? A. To provide medical treatment to policyholders. B. To facilitate communication between doctors and insurance companies regarding patient care. C. To collect and disseminate health information on applicants to help insurers detect fraud and misrepresentation. D. To conduct medical exams for insurance applicants. Answer: C. To collect and disseminate health information on applicants to help insurers detect fraud and misrepresentation. The Medical Information Bureau, MIB, is a non-profit organization that maintains a database of confidential medical information shared among member life and health insurance companies. Its primary purpose is to assist insurers in underwriting and to prevent fraud by alerting them to health conditions or other risk factors that applicants may have omitted or misrepresented on their applications. The MIB helps protect insurers from adverse selection while maintaining applicant privacy by only providing codes, not detailed medical records. Question 8. A policy owner names their spouse as the primary beneficiary and their children as contingent beneficiaries. What role do the children play if the spouse predeceases the policy owner? A. They become the new primary beneficiaries. B. They receive the death benefit only if the policy owner designates them after the spouse's death. C. They are not entitled to any benefit. D. They must wait for a court order to receive the benefit. Answer: A. They become the new primary beneficiaries. Contingent beneficiaries are designated to receive the policy's death benefit if the primary beneficiary dies before the insured or before the proceeds are distributed. In this scenario, since the spouse, primary beneficiary, predeceased the policy owner, the contingent beneficiaries, children, would automatically step in to receive the death benefit. This ensures that the death benefit is paid according to the policy owner's wishes, even if the first named beneficiary is no longer alive. Question 9. Which of the following statements is true regarding a variable life insurance policy? A. Its cash value and death benefit are guaranteed. B. Its cash value fluctuates based on the performance of a separate account, but the death benefit is fixed. C. Its cash value and death benefit fluctuate based on the performance of a separate account, and a minimum guaranteed death benefit may apply. D. Its cash value grows at a fixed interest rate, but the death benefit varies. Answer: C. Its cash value and death benefit fluctuate based on the performance of a separate account, and a minimum guaranteed death benefit may apply. Variable life insurance is unique because its cash value and death benefit are tied to the performance of investment subaccounts chosen by the policy owner, making them subject to market risk. While the cash value fluctuates directly with investment performance, the death benefit can also increase or decrease, although most policies include a guaranteed minimum death benefit to protect against severe market downturns. This type of policy requires a securities license to sell in addition to a life insurance license because it involves investment risk. Question 10. Under what circumstances can a life insurance policy be reinstated after it has lapsed? A. At any time, with no conditions. B. Only if the policy owner pays all back premiums, interest, and proves insurability, typically within a specific time frame, e.g., 3 to 5 years. C. Only if the policy lapsed due to non-payment of a single premium. D. It can never be reinstated once it has lapsed. Answer: B. Only if the policy owner pays all back premiums, interest, and proves insurability, typically within a specific time frame, e.g., 3 to 5 years. A lapsed life insurance policy can often be reinstated, but it is not automatic and requires specific conditions to be met. To reinstate, the policy owner must typically pay all overdue premiums plus interest, repay any policy loans, or have the loan reinstated with interest and provide evidence of insurability, demonstrating they are still a good risk for the insurer. This option is usually available for a limited period, such as 3 or 5 years after lapse, and allows the policy owner to restore the original policy without having to purchase a new one at an older age or potentially higher rates. Question 11. An insured dies during the grace period of their life insurance policy without having paid the premium. How will the death benefit be handled? A. The death benefit will not be paid because the premium was not received. B. The full death benefit will be paid. C. The death benefit will be paid, less the amount of the unpaid premium. D. The policy will be automatically converted to extended term insurance. Answer: C. The death benefit will be paid, less the amount of the unpaid premium. If an insured dies during the grace period, the life insurance policy is still considered in force, and the death benefit will be paid to the beneficiary. However, the insurer will deduct the amount of the unpaid premium from the death benefit proceeds before paying it out. This ensures the insurer receives the premium due for the coverage provided during that period, while still honoring the policy's terms. Question 12. Which of the following is a key characteristic of an adjustable life policy? A. It has a fixed premium and fixed death benefit. B. It allows the policy owner to adjust the premium payments, death benefit, and length of coverage. C. It requires the policy owner to select investment options from a separate account. D. It automatically adjusts the death benefit based on inflation. Answer: B. It allows the policy owner to adjust the premium payments, death benefit, and length of coverage. An adjustable life policy offers great flexibility, allowing the policy owner to increase or decrease the premium, the death benefit, and even the period of protection. This adaptability makes it suitable for individuals whose financial needs or goals may change over time, as they can modify the policy to fit their current circumstances. Essentially, it combines features of both term and whole life insurance, offering a dynamic solution. Question 13. What is the primary purpose of the Texas Life and Health Insurance Guaranty Association? A. To regulate insurance companies operating in Texas. B. To protect policy owners, insureds, and beneficiaries against the insolvency of an insurer. C. To issue licenses to insurance agents in Texas. D. To resolve disputes between policy owners and insurers. Answer: B. To protect policy owners, insureds, and beneficiaries against the insolvency of an insurer. The Texas Life and Health Insurance Guaranty Association is a state-created entity that provides a safety net for policyholders. In the event a life or health insurance company becomes insolvent, unable to pay claims, the association steps in to pay covered claims and continue coverage, up to specified limits, thereby protecting consumers from financial loss. This mechanism helps maintain public confidence in the insurance industry by ensuring that benefits will be paid even if an insurer fails. Question 14. Which policy rider would provide an additional death benefit if the insured dies as a result of an accident? A. Waiver of premium rider. B. Guaranteed insurability rider. C. Accidental death benefit rider. D. Payer benefit rider. Answer: C. Accidental death benefit rider. The accidental death benefit rider, often called double indemnity, provides an additional amount of death benefit to the beneficiary if the insured's death is a direct result of an accident, typically doubling the face amount of the policy. This rider offers enhanced protection specifically for accidental fatalities, which are often sudden and unexpected. It's important to note that death from natural causes would not trigger this rider. The death must be classified as accidental according to the policy's terms. Question 15. A beneficiary designation that cannot be changed without the beneficiary's consent is known as a primary beneficiary. B. Contingent beneficiary. C. Irrevocable beneficiary. D. Revocable beneficiary. Answer: C. Irrevocable beneficiary. An irrevocable beneficiary designation means that the policy owner cannot change the beneficiary, borrow against the policy's cash value, or surrender the policy without the express written consent of that named beneficiary. This designation offers maximum protection for the beneficiary, ensuring their right to the policy proceeds is secured. Conversely, a revocable beneficiary designation allows the policy owner to change the beneficiary at any time without their consent. Question 16. The policy provision that allows an insured to borrow money from the policy's cash value is the A. Loan provision. B. Dividend option. C. Nonforfeiture option. D. Automatic premium loan. Answer: A. Loan provision. The loan provision, or policy loan provision, allows the policy owner of a permanent life insurance policy to borrow funds against the accumulated cash value of their policy. Policy loans do not require collateral, do not affect the policy's cash value growth, and repayment is flexible, though any outstanding loan balance at the time of death will be deducted from the death benefit. This feature provides a readily accessible source of funds for the policy owner. Question 17. Which action by a life insurance applicant would be considered a material misrepresentation? A. Forgetting to list a minor speeding ticket from 5 years ago. B. Stating they are a non-smoker when they smoke 2 packs a day. C. Providing a mailing address different from their physical address. D. Estimating their income slightly higher than their actual earnings. Answer: B. Stating they are a non-smoker when they smoke 2 packs a day. A material misrepresentation is a false statement made by an applicant that, if known by the insurer, would have influenced their decision to issue the policy, the terms of the policy, or the premium charged. Stating one is a non-smoker while actually smoking heavily is a material misrepresentation because smoking significantly impacts mortality risk and premium rates. Insurers rely on accurate information during underwriting to properly assess risk. Question 18. An annuity contract holder typically receives payments that continue for their entire life, even if the value of the annuity is depleted. This is due to which characteristic of annuities? A. Accumulation phase. B. Annuitization. C. Surrender charge. D. Flexible premium. Answer: B. Annuitization. Annuitization is the process where the accumulated funds in an annuity contract are converted into a series of periodic income payments to the annuitant. Once an annuity is annuitized, especially under a life income option, the insurer guarantees payments for the annuitant's lifetime, regardless of how long they live or if the original principal is depleted. This guarantees an income stream that an individual cannot outlive, addressing the risk of living too long. Question 19. All of the following are typically included in the entire contract for a life insurance policy except A. The policy document. B. A copy of the application. C. Any attached riders or amendments. D. Agent soliciting materials. Answer: D. Agent soliciting materials. The entire contract provision states that the policy document itself, along with a copy of the original application and any attached riders or amendments, constitutes the complete agreement between the policy owner and the insurer. This provision ensures that all terms and conditions are contained within these specific documents, preventing either party from introducing outside evidence to contradict or modify the contract. Agents soliciting materials, while used to present the policy, are generally not part of the legally binding contract. Question 20. When an insured selects the reduced paid-up non-forfeiture option, what happens to their policy? A. The policy continues for the original face amount for a reduced period of time. B. The policy's cash value is paid out to the policy owner. C. The policy continues as permanent insurance for a reduced face amount. D. The policy lapses immediately without any value. Answer: C. The policy continues as permanent insurance for a reduced face amount. The reduced paid-up non-forfeiture option allows a policy owner to use the accumulated cash value of their permanent life insurance policy to purchase a new, fully paid-up permanent policy with a lower face amount. The policy will continue in force until the insured's death, with no further premium payments required. This option provides ongoing, lifetime coverage for a reduced sum, offering a good compromise for those who want to stop paying premiums but retain some permanent protection. Question 21. Which rider allows the policy owner to increase the face amount of the policy at specific intervals without proof of insurability? A. Waiver of premium rider. B. Guaranteed insurability rider. C. Cost of living rider. D. Accidental death benefit rider. Answer: B. Guaranteed insurability rider. The Guaranteed Insurability Rider, GIR, allows the policy owner to purchase additional amounts of life insurance at predetermined ages or on specific life events, e.g., marriage, birth of a child, without having to prove insurability. This means the insured's health status or occupation at the time of the increase will not affect their ability to obtain the additional coverage. This rider is valuable for younger individuals who anticipate their insurance needs will grow but want to lock in their ability to get more coverage regardless of future health. Question 22. Which of the following describes the purpose of the suicide clause in a life insurance policy? A. To prevent the policy from ever paying out if the insured commits suicide. B. To pay the death benefit if the insured commits suicide within the first 2 years of the policy. C. To limit the insurer's liability for suicide deaths to a refund of premiums if it occurs within a specified initial period, typically 2 years. D. To pay a reduced death benefit if suicide occurs at any time. Answer: C. To limit the insurer's liability for suicide deaths to a refund of premiums if it occurs within a specified initial period, typically 2 years. The suicide clause is a standard life insurance policy provision that states if the insured commits suicide within a specific period, usually the first 2 years, from the policy's issue date, the insurer will only return the premiums paid, without interest, to the beneficiary. If suicide occurs after this initial period, the full death benefit is paid. This clause is designed to protect insurers from individuals who might purchase a policy with the intent of committing suicide shortly thereafter. Question 23. What is the primary function of the Texas Department of Insurance, TDI? A. To represent insurance companies in legal disputes. B. To educate the public on financial planning. C. To regulate the insurance industry in Texas to protect consumers. D. To sell insurance policies to Texas residents. Answer: C. To regulate the insurance industry in Texas to protect consumers. The Texas Department of Insurance, TDI, is the state regulatory agency responsible for overseeing all aspects of the insurance industry within Texas. Its primary functions include licensing agents and insurers, approving policy forms and rates, examining insurer solvency, investigating consumer complaints, and enforcing insurance laws to ensure fair and honest practices for the protection of policyholders and the public. TDI acts as the watchdog for insurance consumers in Texas. Question 24. A life insurance policy's cash value accumulating tax-deferred means: A. The cash value is never taxed. B. Taxes are paid on the cash value annually as it grows. C. Taxes on the cash value growth are postponed until the policy is surrendered or a withdrawal is made. D. Only withdrawals exceeding the original premiums paid are taxed. Answer: C. Taxes on the cash value growth are postponed until the policy is surrendered or a withdrawal is made. Tax-deferred cash value accumulation means that the interest or investment gains earned on the policy's cash value component are not taxed while they remain inside the policy. Taxes are only due when the cash value is withdrawn, surrendered, or distributed, and then typically only on amounts that exceed the premiums paid into the policy. This allows the cash value to grow more rapidly over time due to compounding, as the growth itself is not diminished by annual taxation. Question 25. Which of the following is the best definition of insurable interest in life insurance? A. The financial interest an agent has in selling a policy to a client. B. The legal right a person has to purchase a policy on anyone they choose. C. The reasonable expectation of financial loss that a policy owner would suffer if the insured died. D. The desire of an insured to have a life insurance policy. Answer: C. The reasonable expectation of financial loss that a policy owner would suffer if the insured died. Insurable interest in life insurance exists when the policy owner would suffer a financial or emotional loss if the insured person died. This requirement ensures that life insurance is not used for speculative purposes and is generally present when there's a close family relationship, e.g., spouse, parent-child, or a financial relationship, e.g., business partners, creditor-debtor. This critical concept must exist at the time of policy inception, as it validates the legitimate need for the insurance coverage.